Welcome back to Morning Trade Live. We got stock futures starting down for a change here as we look at tech, the worst. Joining us, Cameron Dawson's got some charts, some thoughts, some good analysis. The Chief Investment Officer of New Edge Wealth. Cameron, welcome back. Thanks for being here this morning.
Thanks for having me.
If I kind of approach this from sort of two options of explanation for the last week, curious which one you think fits better. Just to kind of start simple here, with tech down, one of the snags of this rotation has been tech soft. Would you say the last week has been more about this kind of pro-cyclical true rotation, or is this just about tech fizzling out?
I think it's really about positioning overall, because we saw positioning get to rather extreme levels short in things like small caps and equal weight, unloved areas that have been left behind, and then get really, really long in tech. You saw inflows into tech go parabolically higher over the last month and a half, which led to parabolic moves in things like growth versus value, a true acceleration of outperformance over the course of June and the first part of July. So some of this is just an unwind from overbought conditions and then a rebound from oversold conditions on the other side. So it then raises the question of how long can this continue? Do you pull back just to trend in tech and then keep on moving up in an uptrend, or do you really break down in what would be a more sustained rotation out of tech into unloved areas? It remains to be seen.
This is where it seems maybe the most important question is about assessing the real cash on the sidelines, the real degree of investment already, household allocation to equities. I mean, a lot of these surveys seem to say that we're pretty fully invested, retail, institutional. Some of the cash is earning pretty good rates now in money markets and stuff, so maybe it's not super liquid. Does that mean we have to take money out of tech if we're going to buy other stuff?
Yeah, it is something really interesting positioning, because people will quote the money market fund balances and see them as fungible dollars that could move into equities or other risk assets. But when we look at overall allocations, they already show that people are pretty fully invested, whether we're looking at institutional allocations here in the 96th percentile for the overall equity market, or household allocations, which are just about 1 percentage point away from their peaks in early 2018, as well as late 2021, which suggests that people are fully invested and all on the same side of the bullish boat. Now, this is a really poor timing tool, meaning that you can see these extended positioning readings persist for some time. But if you start to see a catalyst that could cause people to want to take risk off the table, that could look like anything from cutting earnings or GDP estimates or some uncertainties about policy, that's when you could see a deeper unwind as people move out of their very distinct overweight position right now.
Okay. We're looking, we did have the charts up there for consolidated equity positioning, as well as mega cap growth and tech. I mean, all that stuff was very elevated up into the very highest end of the ranges. So then with earnings too, and the big valuation moves we had, some of these popular Mag 7 stocks trading like 35 forward earnings, Apple even in that range. Does that potentially lead us to think about kind of a top for that trade, or what type of numbers did they got to put up here, Cameron?
I think that's a really important point, because over the last month and a half, what we've seen is the driver of this stock move higher for the Mag 7 hasn't been because of earnings revisions. It's been multiple expansions. So you've seen the likes of names like Apple, even NVIDIA. The upside was far outpaced by what we saw as upward revisions within earnings, which just meant that the last month and a half of parabolic moves higher were rather fragile. And I think the big question going into 2025 is we see the Mag 7 experience, or likely to experience, a big deceleration in earnings growth. You see its earnings growth cut by more than in half. Now, the market has priced in instead, in the areas that have been left behind, an acceleration in places like small cap. So small cap is expected to go from 3% growth this year to 36% growth in earnings in 2025. You could be bullish and say that that's great, small cap earnings are broadening out, or you could be bearish and say that's a really high bar for small caps to jump over. Our view is that small caps, value, international, equal weight, all these left behind areas have to deliver on earnings for this to be more than just a short covering rally and a short-term rebound trade.
What are the chances they do fulfill those earnings expectations? Because judging by the economic data, I mean, is there any reason to think that there's going to be some big surprise in corporate profits this quarter or even the next?
Easy comps help. I think that that is the low bar as we look back at 2024, is we look and see that a lot of names actually didn't experience strong earnings, and that overall S&P 500 earnings growth was really boosted by those Mag 7 names. But then a lot of things have to go right for earnings to do well for the non-Mag 7 part of the market. So if we think about it from the small cap perspective, you need two big things to happen. You need yields to continue to fall, and you need growth to continue to hold up, which just suggests that you need the Fed to be cutting interest rates and yields to be falling, not for the bad reason that the economy is falling off a cliff, but for the good reason that inflation is moderating and they are normalizing policy. So that remains to be seen. And it is a lot that is riding on these yields falling, because one of the key reasons why Russell 2000 earnings have been revised so much lower is because of balance sheet pressure. They have a lot more floating rate debt, a lot higher usage of debt, and that has been one of the key contributors as to why 2024 earnings estimates for the Russell 2000 have been revised down by 25% over the last year. So you have to see that inflect. You have to see an easing in balance sheet pressure with falling yields and growth holding up. That's a big, huge caveat for the Russell 2000 to see better earnings.
Such a good point. Here's the chart showing the Russell earnings revisions falling off. I mean, basically in line with the way growth expectations fell off. That's kind of what makes a cyclical category. So that's my main issue too, Cameron, when I try and explain the market is, all right, we can justify maybe some of this through possible policy shifts. Maybe there's deregulation, maybe there's tax breaks, stuff kind of agnostic to the economy that might be helping some of this animal spirits a bit. But if we just go pure analytical on the market, the bond bull steepening we're getting does not reflect the growth upswing, right? To your point, I mean, that reflects cuts, usually for the wrong reason. I mean, that's just classic textbook, like end of cycle. Fed cuts, we slow down. Bull steepener. I don't know why the market is celebrating this the last 5 days.
And if you translate the bull steepener to a deceleration in nominal growth, meaning that you get less real GDP growth and a deceleration in inflation, that actually challenges 2025 earnings estimates a great deal. If you break down 2025 EPS estimates, they have top line growth accelerating up to 6%, up from the 5% we have this year, and over 100 basis points of margin expansion that's baked in. And that effectively implies a huge productivity boom within the economy, within corporate earnings, because one of the most controversial statements, but it's true in the data, is that inflation is good for margins. Inflation gives companies pricing power, it helps with top line growth, and that bleeds down into the bottom line, gives you margin expansion. It's why margins hit an all-time high in 2021, despite cost pressures. So if you continue to see inflation moderate, that would actually be a challenge for 2025 margin forecasts.
Fantastic point. It's just no matter kind of how you slice it, there seems to be a little bit of an imbalance kind of in some of these expectations. Is there a way to calculate, Cameron, some of the more sort of intangibles of policy, whether it's the tax cut potential, if it's a deregulatory potential? Is there anything in there that could explain away some of the potential profit growth that might not need an underpinning upswing in the economy?
Yeah, it's hard at this point because we don't know what the tax cuts will really look like. We know it's more of an extension of the existing tax cuts. So that's very different than 2017, of course, when you were moving the corporate tax rate down pretty significantly. And so you had a clear way to say what the impact would be on corporate earnings, because it was many percentage points versus what we're talking about today, which is maybe a 1 to 2 percentage point cut in the corporate tax rate. So there is still a ton of uncertainty. Then it raises the question of how you pay for those taxes. the Trump Trump has talked about the paying of taxes using tariffs, which could effectively weigh on demand. Tariffs effectively act as a regressive tax on demand. So the question is, what is the offset that you have in paying for those taxes? So still a lot of uncertainty, a lot of push and pull. What we tend to find is that the more something is priced in the anticipation of the election, the more it's probably a buy the rumor, sell the news kind of situation. It's simply what we had back in the 2016 election. You had a lot of optimism around things like infrastructure, so industrials and materials rallied, and then they gave it all back up in relative performance over the course of the next 4 years.
Great stuff. Cameron, excellent assessment. Appreciate you being here. Nice charts to go with the commentary as always. Good stuff.
Thanks for having me.
Absolutely. Cameron Dawson, Chief Investment Officer at New Edge Wealth. All right, that was some really good sleuthing in the market there of where things add up and maybe where they don't so much, especially a good look at the expectations for next year's earnings.